It's a high risk, high reward package because if Tesla does not meet these targets and the stock does not do well, Elon Musk gets nothing.
I guess you have to catch Elon Musk's attention if you're Tesla these days.
The value of Tesla right now really does seem to be this Musk vision.
Sooner or later, if I was an investor, I would want to see some revenues on the books.
We typically think of Tesla when we think of the top selling EV company, but this is no longer true.
BYD is obviously the most significant player, and it's massive in China itself.
Hey, and welcome to The Dip, the best podcast on the internet to connect the U.S. and global money stories. I'm Kassandra.
And I'm Steven, filling in once again for Daniel. Someone has to pick up for all of his dropped work. Later in the show, we'll be looking at the U.S. economy and what it might look like now that the shutdown is over.
But up first, we're talking Tesla. That's because that company voted for a record-breaking pay package for CEO Elon Musk in an era of growing wealth inequality. We're now talking about a CEO who could see a compensation package worth $1 trillion worth of stock over the next decade.
Joining us now are Seth Goldstein. He's a senior equity analyst at Morningstar, and Tommaso Valletti. He's an economist at Imperial College London. Welcome to you both.
Tommaso, you say this is a very bad deal for Tesla. Why?
Well, it's quite unprecedented. It's unprecedented in terms of size itself and also in terms of the metric design. So basically, effectively rewarding according to market capitalization there is no major precedent in modern economies. So it's quite a big gamble that they are taking with Elon Musk.
Yeah, Seth, let's talk about this pay package itself, talking about a gamble and sort of how far out there this is. It's based on operational milestones as well as milestones in the valuation of Tesla itself. Help us understand how far these stepping stones, these tranches of achievements are from where Tesla currently is.
So there's 12 tranches, and 4 of them are going to be operational targets. So that requires Tesla to build its robotaxis, deploy its full self-driving autonomous software, and get at least 1 million subscriptions. It requires Tesla to build its humanoid Optimus robots and then to grow profit targets, which are currently far above where Tesla is generating today. And then alongside of that, the stock has to react as well. So if it keeps moving up, then Tesla shareholders are doing well, and then Elon Musk will do well alongside them. But it's a high risk, high reward package because if Tesla does not meet these targets and the stock does not do well, Elon Musk gets nothing. So it is a very unique package. There's really no precedent except for the 2018 pay package that Elon Musk successfully achieved all tranches on. But Tesla is a unique company, and so we have a unique award.
You know, Seth, the stock is the linchpin here. We've said it a few times now, but there are already whisperings in the wind that it is overvalued. So what's your take?
I think shares are a little overvalued right now. We think the stock's worth about $300 per share. So the stock's almost 50% above where we think it should be valued. But the market has been very optimistic on Tesla's growth prospects as they've started testing their robotaxis in multiple U.S. cities, and as we've seen the testing progress. So they've added more cities, they've expanded the testing area in some cities like Austin, Texas, and they're getting ready to remove the safety drivers, which are currently sitting in the passenger side up front in the cars, which effectively makes a Tesla similar to a Waymo, where it truly is driverless and the machine is doing everything.
Tommaso, if I have this right, the highest tranche 12, essentially means that Tesla would be valued at double what NVIDIA is currently valued at. Is that fantasy, or can we imagine a world in which that actually takes place?
So you have to remember that these packages are to give Elon Musk, the CEO, the right incentives. On the operational metrics, the number of cars, 20 million, which is a number that Musk has been floating for some time, it's not a very ambitious number if you think about it, because it's 20 million over 10 years. That makes 2 million cars per year. And Tesla right now is selling about a bit short of 1.5 million cars. So it's not such a big change in the trends we currently see. A rival of Tesla, which is BYD from China, is already selling 5 million cars per year. So that metric in itself doesn't justify the market valuation. The strange thing in a market, in a compensation for an executive is, as I said, to give the incentives, usually should be linked to some metrics which are related to the profitability of a company. So market capitalization itself has to be sitting on some revenue growth, and these numbers, 20 million cars, do not justify that revenue growth that would feed into a market capitalization of $8 billion, of $1 trillion. These numbers are even difficult to say. So it's not designed well. Yeah, but it's not designed well. So what actually Musk is doing, obviously, is selling a dream. Is again trying to selling a dream. Is trying to sell a hype. This market capitalization, is it sitting on what? We want to see some fundamentals, and these fundamentals are not there yet. Okay, so it's selling a dream. Maybe that's selling the first man on Mars. Is selling the first man who gets $1 trillion package for himself, but the underlying economics are not as strong.
I guess you have to catch Elon Musk's attention if you're Tesla these days. Seth, you talked about self-driving cars. Tommaso just talked about the actual Tesla fleets and sales of those cars. What about these humanoid robots? There are metrics around the creation of these robots, the deployment sounds nefarious, but basically the development and sale of these robots. Where are we right now with the robots? Are there any? Are they in development? What can we say?
We're in the very early testing phases for robots right now. So Tesla is still trying to figure out how to train the robot to first be useful in its factory. So think of, in a factory, you need to move parts around. A robot can do that and replace a human. You need to load and unload, say, battery cells, put them on the line, move them from one line to another. They're first trying to train robots to work in Tesla's factories and then look for other companies that would have similar jobs in factories for robots, or maybe like an Amazon warehouse where the robot can be useful and essentially replace human labor. Longer term, they want to develop the robot to be able to be trained in our own homes. Now, I think that is far, far away, probably past this compensation package, more than 10 years out. But I think within the next few years, we do start to see Tesla robots, at least working in their factories, progressing towards being able to sell them to another company.
Just to be clear, I read somewhere Elon Musk saying that he sees these robots helping stop crime, for example, that they have this kind of use that goes well beyond an Amazon warehouse. Does that not throw a bit of doubt upon this whole pay package and the reality behind it?
Well, when you hear Elon Musk talk, I think we have to separate Elon, the visionary, who has this vision of the future that he can create, where robots are in our everyday lives and helping do things like be our personal assistant around the house or potentially help stop crime, versus Elon Musk, the CEO of Tesla, who wants to build a profitable product and sell it to another company first. So if we're looking over the next 10 years for the pay package, I think we should just limit the robot focus to training them to be useful in Tesla factories and then sell to another company for manufacturing or warehousing type of purpose.
You know, Tommaso, when we're talking about some of these figures, you know, even as I'm writing these scripts, I have to make sure I have enough zeros because it looks wild, right? When we're talking about $1 trillion pay package. But Musk is, you know, depending on what day of the week it is, he is the world's richest man. This would definitely make him the world's richest man. Could he just buy these cars or robots to meet the benchmark?
Well, if you look at those numbers, buying 20 million Tesla cars is going to cost you less than $1 trillion. So he could eventually, with his wealth, buy those targets and award the package. It's a kind of a semi-joke. But I want to go back to the fundamentals. So typically, we want to give incentives. So this is wrong. If there is a rising market, a bull market can lift valuation regardless of managerial input. If you're selling ice cream and you want to reward your CEO, you're not going to reward the CEO on a sunny day because everybody is going to buy ice cream on a sunny day. It's not because of instead, if they sell a lot of ice cream on a rainy day, they must have done something really interesting. Here in this package, there is no benchmarking. Usually, there is no profit. There is no relative return. There is no accounting metric vis-a-vis what the market is actually doing. It is absolute market capitalization, which is the dream, the future, the potential. But we've been going on this potential for many years. Maybe we still ride this wave going high. But sooner or later, if I was an investor, I would want to see some revenues on the books.
Speaking of investors and shareholders, Seth, this package was passed by shareholders, but notably with less support than that big pay package from 2018. What does that tell us about the reluctance here?
Well, I think the numbers were a little scary for some investors and a little big. Uh, $1 trillion in potential total compensation for Elon Musk. I think that number turned a lot of investors to vote no. But that being said, we still saw a strong majority voting for the package because if Tesla is successful, it can transition the company from being an automaker today to selling cars that can drive themselves, selling humanoid robots that can be useful in some business case, then Tesla is going to see its market cap go from being valued like an automaker to being one of the most valuable companies in the world. And I think shareholders are excited about that possibility and would be happy to share some of the upside with Elon Musk if he can make that happen.
You know, there's excitement around Elon Musk and his vision, but then there's also the fear of what happens if he were to leave. Tommaso, the value of Tesla right now really does seem to be this Musk vision, but it can't. I wonder, are Tesla shareholders and the voters behind these package, are they being held hostage by the Musk brand?
So, in general, I would want to say that proxy advisors like Glass Lewis, regulators are typically against absolute market cap type of packages. So they're against because they are non-performance based. But the fundamental question is, if the current market capitalization already reflects the Elon's factor, already reflects the Elon's vision, what is the extra added Elon vision which is coming? What's the delta? What's the thing that we unanticipated until now that may make the market capitalization go up by a factor of 6? But now it's about $1.5 trillion. The market capitalization a bit less of Tesla. You have to multiply by 6 to get to 8 trillion. Sorry, I keep making the mistake because it's a figure I cannot command. So, and what is it? What's this vision? Is a few robots that are gonna. So it's the dream. It's the dream which keeps compounding itself and that becomes bigger and bigger. Or is it like drug addiction? Is that an addiction? So this is the question.
Seth, right now, shareholders with Tesla seem mostly, a majority of them seem happy to extend this package to Musk to allow him really to shoot for the moon, to sort of continue this hype and see what they can reach in terms of market cap. How long can this last? How soon could this get bumpy? What do you foresee?
Well, if you're a Tesla shareholder, you believe in Elon Musk's vision for transforming the company to this AI and robotics company from a car maker today. And it's really cool and it's exciting and you can share in the upside, but Tesla's still in the very early days of its two products. The two big products, if Tesla's going to achieve these milestones, will be cars that can drive themselves and humanoid robots that are useful. If Tesla can do that, then the vision works out, everyone makes money, and Musk gets paid. But if not, if we see cars get into an accident, for example, if we see the humanoid robots not be able to be useful to be sold outside of Tesla, then all of a sudden these dreams would not have that great of a future anymore, and we see the stock likely fall, and as a result, Musk would likely walk away with no compensation.
Just following up on that, if he doesn't hit these milestones, won't he still earn a lot of money? Let's say these robots don't work out, something like that. He's still going to make a lot of money by achieving a certain number of these tranches. Fair to say?
He does not have every chance he achieves, he gets 1/12 of the stock options. So he does not have to achieve all 12 to get the full pay package. But if he wants the one compensation, which would give him more than a 25% ownership in Tesla, which is what he has long sought, then he needs to hit all 12 milestones. Otherwise, he will be below his desired ownership stake.
Many thanks to both Seth and Tommaso for that great conversation. Well, we want to zoom out now when it comes to the EV market and really take a look at the global situation. And of course, the biggest part of that is China, where we see that dozens of companies are producing cheaper and what many consider generally more advanced models. So where's this all going, and what does it mean for legacy car makers, including those out of the US?
Yeah, so really the big question is China going to swoop in and just dominate another cutting edge industry just like they did with solar panels, rare earths and batteries, or can American car companies keep up in the race for the future of the auto industry?
And for more on that, we have two great guests joining us now. Katherine Yusko, she's a research analyst at the American Security Project. And we also have our very own Clifford Coonan. He's DW's China analyst. Thanks to you both. Katherine, I want to begin with you. We just spent a lot of time talking about Tesla and how much its business model is changing when we look at these kind of robot aspirations, self-driving cars, things like that. I'm curious, Tesla was, of course, the pioneer in electric vehicles, and of course, it broke through in China to really become this kind of global provider. What is the situation with Tesla in China right now?
Absolutely. So Tesla has a factory in Shanghai, and it is continuing to produce vehicles. For a long time, Tesla was the primary exporter out of China, but now China's exports of electric vehicles are dominated by Chinese companies. So while Tesla really helped to drive forward the electric vehicle industry in China, China's now exporting its own vehicles made by its own companies that are succeeding.
In our setup, we frame this a little bit coyly, and I can hear the commenters already tip-tapping away. But we kind of frame this as, American EVs versus Chinese EVs, like as if they're neck and neck. But they aren't really neck and neck, are they?
No, not at all. In fact, I would say that US China competition in the EV space is becoming more and more of a fiction. China is dominating in every aspect of the EV race. Last year, it manufactured about 12.4 million electric cars. This amounts to 80%, or excuse me, 70% of global production and over 11 times the number of electric cars produced by the United States in the same year. It also exported more than the US and the European Union combined.
Wow.
So China is really delivering in terms of price and quality. It is not only delivering the highest volume of vehicles, it's also producing vehicles that are more technologically advanced than many of its competitors. So while China is all in on EVs, we're seeing US companies pull back on their electrification goals. And the competition is really becoming less and less of a race and more China getting further and further ahead.
Clifford, there are a lot of Chinese EV companies, dozens, in fact. I'm not going to ask you to name all of them, but maybe you could help us understand which are the biggest and most important.
Well, I think BYD is obviously the most significant player, and it's massive in China itself, which is where it built its initial market share. I think to understand, before we look at the companies, maybe just to see where this is coming from, why there are so many players, first of all, is because it's part of China's industrial policy to have as many, for local governments, for example, to set up car companies. You have all kinds of different state agencies that are operating car companies. Former motorcycle factories are relaunching as car companies, e-vehicles. It's just part of a policy, which means that you've got massive amount of these companies. I mean, there's about 109 brands at the moment.
Wow.
Probably about, certainly the figures are constantly varying. It's very hard to actually keep tabs on them. But probably about 40, maybe 45 producers. And they range from these local government producers to the top end ones like BYD, like Great Wall, which is a traditional, has traditional strength. You also have Xiaomi, which makes everything from smartphones was the original thing,
Yeah.
but they also make fish. They make aquariums, smart aquariums. They make rice cookers. It's kind of like, it's almost like in economics terms, it would be like perfect competition because there's just so many. But the thing is that it's all backed, or so much of it is backed by subsidies from local governments, and each are trying to compete with local governments in other provinces. So while it's produced BYD, which is an incredibly efficient and a very successful company, it's also produced an awful lot of inefficiency, overinvestment, waste, and so there's probably around 11 sustainable now, and I think we're going to see that that's probably going to consolidate further as well.
Katherine, when we look at the policy approaches to electric vehicles in China and the US, we heard there about some of the subsidies to these companies. They're really far apart, aren't they?
Absolutely. So one of the biggest figures that sticks in my mind is CSIS published a report a little while ago reporting that China had invested, or the Chinese government had invested, an estimated $230 billion into its electric vehicle industry in the last 15 years. And this was using a variety of tools, preferential financing, R&D programs, infrastructure funding, et cetera. So the CCP has really intentionally poured money into this industry. And the United States, frankly, has not. It received a lot of support in the industry from the Biden administration, from tax credits to charging infrastructure programs. And these did help to reduce financial barriers to EVs and reduce concerns like range anxiety. But it can't match the level of support that China has poured into this industry. And with this administration, with the exception of Trump's brief bromance with Elon Musk, the EV industry has really experienced downright hostility from the new administration. And I don't think we can expect to see very much government support pouring into the EV industry from the US side anytime soon.
Katherine, when it comes to producers of EVs, when we look at China, we see a lot of production, and especially on the operating system side, really with young people in mind, kind of an excitement there. There's almost an app network that these cars have. We saw something similar with Tesla, obviously, a lot of first adopters of EVs really going for it. Is there something similar amongst other producers in the U.S., this kind of trying to appeal to a really younger sort of first adopter market that does sort of create a kind of excitement around electric vehicles still, or is that just sort of different? Is that passing as these subsidies pass, for example?
That's a great question. And, I can't comment authoritatively on, the markets that these different producers are trying to attract. But I would certainly say that a lot of the younger generation is attracted to the environmental benefits that EVs provide. They're attracted to the new features that EVs are able to provide. And I think as this technology progresses, it's going to appeal to a wider body of individuals. I think the price has really been a major barrier to EV consumption in the United States. So as battery costs are reduced, and as EV prices come down, EV companies are going to be able to market more effectively to a younger population who's very excited about these technological innovations, these environmental benefits. But that's going to require, some time or support to the EV industry.
Clifford, who are these Chinese EV firms selling to? Is this part of the larger strategy that we've seen out of China to boost exports in order to boost the overall economy? Because we've seen the domestic economy in China lagging.
Absolutely. I think it's part of a broader outward push by China because it's finding it very difficult to generate domestic demand in consumer goods. Even in the EV business, so much of the market is already so saturated that it's quite difficult to create new demand. Looking at the Chinese economy, exports are the only area where there's any kind of real vitality at the moment because the property market is still in big trouble. And with the impact of tariffs, the trade war, it's causing a lot of problems. So China's government has gone out. China's gone out and it's looking to the neighbors. It's in Southeast Asia. It's selling a lot to Russia, and then it's obviously pushing in Europe, as we've seen. The fact that there's now whatever. There's like 100% increase, or there's massive increase in the number of EVs being sold here, while Tesla sold 750 last month, which is just incredible. So you've got, it's clearly, it's paying off, but it's a push. It's also politically risky because you're flooding the market with these goods, and it's very difficult. There's no real on or off switch the way that China approaches industrial policy, because it's essentially a political decision. It's not based on economics. It's about boosting the Communist Party and keeping the Communist Party in a secure position, and that forms the backdrop to pretty much every decision that gets made, every commercial decision. So it's not like other markets. It's not, you can't really compare, and that's why they're able to, as we've been discussing, as Katherine was saying as well, about the subsidies that they can give, which are impossible in a free market. They're impossible because the markets won't allow it. So basically, it is all about pushing exports as a way of keeping the economy ticking over until domestic demand kicks in. But then a lot of people say in order to get domestic demand, to get consumer demand going again, you're going to need reform, and that reform isn't going to happen.
And that 700 figure that you mentioned, Clifford, that was just one country. That was here in Germany, right?
Yeah. That's right. Yeah, it's very,
Yeah, moving on, Katherine, we talked about Tesla earlier in terms of how it's doing in China, and sort of it's getting beat there. It's getting beat elsewhere globally from Chinese brands, BYD in particular. We're starting to see that evolve. Tesla, I should say, really is this kind of flagship, the American representative for the auto producers, the electric vehicle producers. A lot of other producers not really sort of in this kind of game to the same extent. And yet it's moving on in many ways to as I mentioned, sort of robots, self-driving vehicles, things like that. Is there a sense that even it's sort of giving way in this kind of race for actual sort of pure EV autos?
It's so interesting you say that, because I thought the same thing. It's an electric vehicle company that really branched out. It's going to invest in Musk's AI company. And I think what we're seeing is really sort of a convergence of technologies. And I think we'll see that a lot more in the coming years. So, EVs can't stand alone in a vacuum. EVs are going to benefit from other technologies like AI and robotics. And I think that Tesla has revolutionized the EV industry before. Tesla revolutionized the global auto industry. So as it pours its resources into developing these other technologies, I think right now we're seeing a very odd sort of mix of technologies. But I think in the end, we may see a company that is able to bring these elements together. Of course, I could be completely wrong, and it may move away from EVs altogether. But I think that, the global trend is clearly seeing an uptick in EVs. From my perspective, it looks like Tesla is bringing together an array of technologies to make their product even more competitive in the global market. And I don't see it backing off of EVs soon.
Katherine, we've been talking about Tesla, but I'm just wondering, is there any other American company also trying to, run this race, drive this race? Like, who else is in the running here?
Absolutely. So you have companies like Rivian and Lucid that are coming up with cutting edge EV technology. You have traditional American automakers like General Motors and Ford who are also trying to run this race. But as I mentioned earlier, some of these more traditional American automakers like GM and Ford set these really ambitious electrification targets a couple of years ago during the Biden administration, when it really looked like there was a push for electric vehicles in the United States. Now, as that demand certainty it starts to roll back, as automakers have seen that U.S. demand for electric vehicles is not what they thought it would be, they're starting to roll back on these electrification goals and sort of slow their race a little bit. So I don't think that these automakers that are in this race are going to pull back altogether. But we are seeing sort of a slowdown in their commitment to electrification.
Clifford, we touched on this a bit already, but it's really, when it comes to the electric vehicle, it's about the value chains that are around it that China has really dominated as well. And that's batteries, that's rare earths, as we've seen recently. For competitors, it's incredibly important to take parts of those value chain, but is it realistic, given that, for example, I think here in Europe, for example, I think something like 90% of rare earth imports are from China?
Yeah, rare earths is really interesting, and as is the battery market. I mean, all of these. I went to BYD maybe 15 years ago, and it was a battery company then, and it was all about putting things around batteries. It was about mobile phone batteries. It was about electric buses batteries. They had a city bus race when I was there. It was really hilarious. But it's always and about obviously cars, and now they've got these fast charging cars. It's all about delivering batteries and different products. Because it's central to everything, and rare earths are part of that whole argument as well. And obviously, when China turned off the taps recently on rare earths, everyone, if that isn't too much of a mixed metaphor, but anyway, when they stopped the rare earths recently, and everyone got a major fright, it was a sign of just how dependent everyone was on China for rare earths. What's interesting about that is that it was obviously a ploy in the trade war to show that China can do this. And it was able to leverage stand down by President Trump, and it had short-term impact, but long-term it means that there's been a huge focus, even in recent months, for countries and like the EU and obviously the United States. They're all looking at securing rare earths, their own rare earths, and there's a feeling among some people you talk to that basically. That China may have overplayed its hand in a way because it's now lost that it could soon lose that leverage, and other countries are sort of stepping up in Africa and in Latin America, all over the place. They're coming up with these rare earth alternative sources for rare earths. So it's really interesting in geopolitical terms to look at it, how this sort of economic factor has kind of transformed the whole situation.
Yeah, Katherine, we've been talking about this trade war, tariffs, and those are a really big part of the story here. BYD is poised to be the top seller of EVs this year, but it doesn't actually sell their vehicles in the US because of the high tariffs on Chinese cars. So, do you think at some point Americans are going to see other countries getting cheaper, maybe even better electric vehicles and say, hey, what about us?
I think that's a real risk with the economy as it is. For reference, the cheapest Chinese EV model on the market sells for less than $8,000,
Wow.
while the cheapest US EV model on the market starts at over $33,000. So there's a pretty big discrepancy. And I think that, Americans have sort of swallowed this 100% tariff saying, it's protecting our domestic industry. It's protecting us from potential surveillance equipment, which is a concern in Chinese EVs. But I think that political skepticism towards China is not enough to bridge that massive price gap. I think, if Americans are seeing countries all over the world getting vehicles for a fraction of the price of the ones that are available in the United States, I don't know that the constituents of America will be very happy with that for long. I don't think people will sort of sit by and allow that to happen. So I think America is going to have to come to a reckoning at some point with how it's excluded Chinese vehicles from its market.
Now, one story we've been following here at The Dip has been what is even happening with the U.S. economy.
That's right. Like a lot of business journalists, we're really interested in the fact that there's been this kind of lack of basic economic data during the shutdown. Think of jobs numbers. Think of inflation numbers.
Yeah, what are we even supposed to nerd out about without those numbers, right? So something that we've been thinking about too is the fact that it's been so topsy-turvy even before the government shutdown, with tariffs all over the place.
Yeah, Kassandra, that makes these numbers even more important. So recently I brought this up to Ulrike Malmendier. She's an economics professor at UC Berkeley. And here in Germany, she's actually one of the top economists. And she has a special role in helping forecast the German economy going forward. So I began our conversation by asking, okay, if you're an American economist trying to forecast there, how difficult is it right now without that data?
I would say that's an aspect of the shutdown I'm actually not as concerned about. In general, the US has been actually at the frontier of providing data, of using data. If we now have a couple of weeks, even if it's a couple of months that are missing, generally we're able to fill in the gaps ex post. So in that sense, if the US returns to the path they were on, I think the colleagues at the Council of Economic Advisors will be happy enough.
Give us a sense, what picture are we seeing in the U.S. economy right now? This is where you teach, where you live?
That's right. So what we do see is that the stock market, has been doing great. Often that's then generalized to the U.S. economy. However, it turns out that the so-called Max 7, so these kind of tech firms, are really driving it. In terms of one of the big projects of President Trump to strengthen and support the manufacturing industry of the U.S., there's little evidence that this is happening. I wouldn't even blame him because the manufacturing has been on a decline with, little blips up and down for various events that happened. I don't think that this is stoppable. The big question we're all asking right now is, to what extent will AI be able to lead to productivity, lead to growth? Will the US firms manage to put it to a productive use, or will it may remain in the realm of just kind of feeding consumers with certain information and services, which at the end of the day won't be that profitable?
Ulrike, today you really focused on the German economy. The German Council of Economic Experts, of which you're a part, has released its fall prognosis. U.S. tariffs have been especially harsh on German companies who export. How much of Germany's economic problems are because of what's happening in the U.S.?
Well, indeed, the export industry, which has been a pillar of German growth, has been weakening. We have to be clear about the fact that this has started already earlier. German economy, the German export-oriented firms have lost their competitiveness. It's particular in terms of the prices at which they're able to offer their goods. In the past, that was remedied by German quality often being unreached around the globe by other countries. But even countries like China, which traditionally maybe weren't producing at the same quality level, are catching up, are overtaking us. So the Germans have to learn to become more competitive on the price sector. The other big factor the German economy is suffering from is the lack of labor. We just don't have enough hours worked by people. That's weakening the German economy general, and is also not good for export orientation. So then add on top of that the volatility induced by the reversal of economic policy, trade policy we have known from the US over the past decades. That's a double whammy that's hard to digest for the German economy.
Ulrike, you focus on behavioral economics, such as the way past experiences affect current decisions by consumers, for example. Given inflation, given tariffs, given the rhetoric in the world right now, how difficult has it become to predict consumer behavior in places like the US and Germany?
Yeah, it has almost become a running joke that at every new prognosis, not only us, but also other institutions are thinking, okay, consumption spending has to pick up again. Consumers have to become optimistic again. And then yet again, we are wrong. And consumers are more scared, are more careful and cautious in their spending. So the constant exposure to one crisis after the other, starting maybe with COVID-19, then here in Germany in particular, the energy crisis induced by the Russian aggression towards Ukraine and the war in Ukraine. And now for our economy, the shocks through the new trade policies, tariff conflicts, that creates an uncertainty which won't be remedied once all these problems are solved. Suppose we could perfectly solve all these problems, go back to the status quo where we were before. Unfortunately, people would still act in a more scared way, be more cautious in their spending. So the only remedy for that is we have to generate stability. I do have high hopes that the Europeans can get their act together and create that stability in the European Union, lower the barriers, make this one common single market where firms can trade, can finance. I think that would be an excellent way out of these uncertainties and volatility.
One of the focal points, in fact, of that new report is capital markets across Europe and in Germany. And we see that there's a recommendation, or that I should say that the Council of Experts is in favor of the development of more private retirement funds in Germany. This is something that in the U.S. has long been around. I would imagine this is akin to the individual retirement account or the IRA. Maybe some people are wondering, why don't they have such things already in Germany? Maybe you can give us an idea of the differences between household investment in the U.S. and in Germany.
Yeah, that is an excellent question. Why on earth do the Germans still not have a capital market-based retirement system? It just turns out when you start from a pay-as-you-go system, it can be really hard to implement that change. And one politician after the other, one administration after the other has been kind of reluctant to implement change there, didn't want to scare off voters. I do have really high hopes for the current government that they will manage it. I'm very proud to say they built on an idea we developed in the Council of Economic Experts here in Germany, the idea of a youth portfolio, which is now called the Early Start Retirement Program, so that already when you're at school age, you start investing just 10 euros a month in a broadly diversified capital market-based account. We feel that, I mean, my research on experience effects argues that that would help alleviate these concerns, these deep-rooted fears Germans have about the stock market and about capital markets. And it looks as if even then adding on, so that's from age 6 to 18, adding on for the population that's actually working, the working population, having at least an element of private capital market-based retirement saving is feasible. It is going into the parliament. I very much hope we can utilize the momentum and finally get to the place the US got to 60 years ago, the Scandinavian countries got to 25 years ago, UK has a similar system. Let's hope it gets implemented now.
And that was just a snippet of our full conversation. If you want to see the rest of it, check out our DW News feed on YouTube.
That's right, but that's it for us this week. If you like what you heard, you can subscribe, and you can follow us wherever fine podcasts are sold.
And if you like what you've heard here, be sure to tune in Tuesday when we answer your questions in our Q&A episode.
Until then, you've been listening to The Dip.